Hello everybody, my name is Lesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is about growth stocks and their profits, if any. Let's talk about value first. Value is more standard, what you would think of as a normal business. Companies that make money, they may pay some of their profits back to their owners, the shareholders, in dividends. You buy them low and see them succeed and then sell them high. Growth companies are kind of the other side of things. They are growing, usually young companies. They're not the buy low, sell high assets. They're priced high, but expecting to go higher. Because they're growing, they're often putting all the money back into the company and they may not make a profit. Sometimes this is done via creative accounting, which expenses capital investments, so no profit is made and no taxes are paid. Amazon did this for years. Usually the company is running at a loss, but if its sales are growing and once it reaches a certain critical mass, it can lower costs by becoming efficient and make a profit. Investors will give the startup time to get there. This may take years and investors may be more or less patient. The typical thing is that investors see something new, shiny, and revolutionary. So, for example, electric vehicles, renewables, a new drug, a medical breakthrough, and they pile in. They drive the price up without any fundamental support, just all on expectations and excitement. The company stock is priced with future expected cash flows and profits priced into the stock, and the price to earnings ratio may be huge or undefined if there's no earnings slash profits. This is the risk in investing in these companies. Number one, they may never become profitable, they bleed cash, and they just go bankrupt. Number two risk is the investors may lose faith and just start selling, and then others will start selling more because they've made a profit and they want to lock it in. And then number three risk is the stock price isn't pinned to actual profits and can have a lot of movement. So you'll get a lot of volatility because nobody really knows what the company is worth. And it's all just based on sentiment anyways. Now, if the company makes it and becomes profitable, you will be well rewarded for your risk because you got in early before the company got real profits. Once it starts making profits, the price probably won't go up much, but it will definitely go up because the expected profits were already priced in, but the company has become stable and now the expectations have become reality. If the company doesn't make it, it will fade into obscurity or at best be bought at a low price for its technology. Now, eventually, fundamentals, such as is the company making money, will win out and the company must make a profit. As Warren Buffett says, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So we know on sentiment what the company might be worth, but eventually we have to get some profits to know exactly what it's worth. So at the start of a company's life, there can be excitement and its stock can become overpriced, but over time, things go back to fundamentals. Is the company making money? Also, a lot of analysts use the discounted cash flow model to evaluate all stocks to see and calculate the current fair value. The growth stocks, with a lot of far out in the future expected cash flows, get discounted at a certain rate to their present value. So what happened at the end of 2021 with growth stocks was partly that interest rates were going to go up. This means that in the models, in the discounted cash flow models, the future cash flows were to get discounted more than previously, and thus the current fair value of the growth stocks was lower. And so they sold off to match their lower fair value. They sold off a lot. Not much happened to value stocks because their profits and dividends were happening now, so they weren't getting discounted much. and the higher interest rates were not affecting them quite as badly. So that's my view on growth stocks. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.